So Philippe, for Cartier Resources, can you give us a rundown of what and where your flagship project is?
Well, our flagship project is an old Chimo Mine project. It was a past-producing gold mine, just 30 or 40 kilometers outside of Val-d'Or, so proximal to infrastructure and workforce. It ceased production in 1997, not for lack of ore, but because the price of gold had dipped under $300 an ounce. So we believe there's still a lot of upside. There was a reserve that had been measured at the time. It's not 43,101. What we're aiming to do is to increase that in the upcoming year by intense diamond drilling.
Right, and so 97 was the last time that anything was produced there?
Indeed. 1997, it was then put on care and maintenance. The price of gold never really lifted until 2003. By that time, it was owned by another company that ended up going bankrupt. We purchased the mine for $261,000. That attracted the attention of several senior companies that signed non-disclosure agreements, eventually led to Agnico Eagle taking a 19.9% stake in us. It attracted some money, attracted even more money. So now we sit with about $13 million in the till, and we've just launched a 50,000 meter diamond drill program.
Great. Now, let's talk about that drill program.
Yep.
Give us some key highlights about it.
Well, the key highlights is the program itself on Chimo Mine is 44 holes. It will cross 177 gold-bearing structures on 24 separate gold zones that were established or discovered by the past operator of the mine. Now, it's obviously a advanced exploration project. We will be drilling 25,000 meters on that project alone, 20,000 meters around the shaft, and 5,000 right beneath the shaft at the lowest operating vein.
And how much is the program costing you?
About $3 million. So we'll still have a lot of cash by the end of the year, and by then we'll have added a lot of value to the mine site.
Well, at the end of the year, what are your next steps after the drilling program ends?
We're going to re-engineer a new program to go even deeper and to sort of put some more meat on the bone on this thing. And we're hoping to attract a player that will take it the full 9 yards and back into production. And that's where our shareholders stand to benefit, is when we sell this asset at a premium to a producer that wants to replenish its reserves.
Right, and I know that you yourself, you're a geologist, but who's working alongside you at Cartier?
We have our Vice President, Gaetan Lavalière, a PhD, a young computer-driven geologist, Ronan Deroff. We're a slim team, only 3 members, and we hire consultants and contractors to get the work done, basically.
All right. Well, aside from the peers who are operating in the area,
yep.
Why Cartier Resources as an investment opportunity?
Well, because we're in a district that is steeped in mining culture and mining history, in a district that has produced over 100 million ounces of gold. We're in a district that has a good social acceptance of mining as a viable economic output. And the mine itself has a shaft that goes down to 920 meters. So by virtue of that alone, when we demonstrate that we have enough ore, it can be brought back into production extremely rapidly and benefit the local communities. For an investor, that's about the lowest risk you can actually take with your money and get the highest reward. So we would really like people to go on a website, check us out, do their homework, do their due diligence, call me if need be, and then we would like them to invest in us.
Well, the general idea is that mining ore is on the decline.
Yep.
What do you say to investors who say, hey, Philip, what do you say to me about this?
In 1997, for every ounce that you were mining, you were finding 1.4 ounces of gold. Today, in 2017, for every ounce that you're mining, you're only finding 0.3 ounces of gold. So the reserves, worldwide reserves, are rapidly depleting. In 1997, the cost of finding an ounce of gold was $11 an ounce. Today, to find the same ounce of gold, you're looking at about $150 an ounce. We hold gold ounces in store, and we try to augment that, and so that becomes very attractive for local mining companies. And we're still undervalued. We're still trading at what we think is way below our proper valuation. So that's why we're a good investment thesis.
All right. Thank you so much for your time, Philip.
I thank you.